Assalamualaikum warahmatullahi wabarakatuh. We are from Group 5 of International Taxation. Want to present to you about double tax avoidance agreement on tax treaty or P3B. So first of all, let me introduce myself and my member. My name is Raihan Raditiya and my team member is Avelia Zahara and Muthia Putri Hefra. So the first slide will be presented by Avel. To Avel, time is yours.
The first is background triple PB or tax treaty. Triple PB arises because of the clash of tax jurisdiction between capital exporting countries and capital importing countries. The two countries have an economic relationship that is inseparable from the aspect of taxation. As the result of this conflict, taxation is not imposed at all in two countries, or is even imposed twice in each country. To avoid these two effects, it is necessary to have agreement between the two countries that carry out economic relations. These arrangements are then contained in the Triple PB. The next is, what is the Triple PB or tax treaty? Triple PB or tax treaty is agreement between two countries to modify the respective tax law and regulation. Usually, what is the modified is the provision regarding income tax only. So, other tax such as value-added tax or PPN, luxury sales tax PPNBM, and land building tax and stamp duty are not regulated in Triple PB. Triple PB has two main objectives, namely, the first is facilitating international trade and investment flow between countries. And the second is it is a tool for the both contracting states. The next is the five goals of the tax treaty. The goals first is there is no double taxation which is burdensome to the climate of the business world. The second is the increase in capital investment from abroad. The third is improvement of human research. The fourth, exchange of information to prevent tax evasion. And the last is equal position in taxation between the two countries. The next is principle of income tax imposition related with the tax treaty. The application of tax treaty is the inseparable from the principle of the imposition of short tax. The first is domicile or citizenship, in which to avoid double taxation. Then we need rules governing this triple PB. The main principle of used as the basis for imposing tax are, the first is domicile principle or resident principle. Domicile or resident principle, the state will impose on tax and income received or obtained by an individual or entity if the individual is resident in the country, and can be domicile principle evidenced by the provision of Article 2 of the Income Tax Law, the which states the foreign resident of a country will be taxed in the state of Indonesia, and if it exceeds 183 days and is required to have taxpayer identification number or NPWP, this provision also makes all work income must calculate in the state of Indonesia if the resident already has NPWP in Indonesia. The second principle, it is the source principle. The source principle will impose tax where individual or entities earn income and don't see where a person or body is domiciled. The most important thing in the applying the source principle is type income is not subject to tax. The tax is only levied on the tax subject in the country is earned income. And the last principle of of citizenship. The principle of citizenship is also applied when a citizen Indonesia whose net income has exceeded non-taxable income tax or PTKP, then he is required to have a NPWP. Anywhere they are, as long as they have Indonesian citizen, they are calculating worldwide income in the state of Indonesia. The short principle is imposed on foreign resident or foreign entities. Obtaining income from the state of Indonesia must pay tax withholding tax mechanism. The, the position the, the position triple PB tax treaty in domestic law in Article 32 allow number 7 of 1983 on income tax. The government authorities to make agreement with the government of the other country in the framework of double tax avoidance and the prevention of tax evasion. The position of the triple PB based on this provision is like specialist agent domestic law. Thus, if there is provision in the domestic law country to the provision in the triple PB, then the priority is the provision of triple PB. Definition of domestic tax subject in tax treaty based on Article 1 of the model Triple PB Indonesia state that Triple PB applied to person entities who are resident of one or both contracting states. For the purpose of the Triple PB based on Article 4, Paragraph 1, Model Triple PB Indonesia refers to a resident of contracting state. Which is according to the laws of the domicile, his place of residence, management position, and another basis of similar nature. In the case of Indonesia, the definition of resident of contracting state shall revert to definition of domestic tax subject stipulated in the PPH law as the method are based on the Article 2, Paragraph 3 of the PPH law for the taxation purpose. The domestic tax subject are the first is person who residing in Indonesia for more than 183 and in tax year located in Indonesia and has intention to reside in Indonesia. The second is entities established or located in Indonesia. And the last, an individual legacy as whole replacing the direct whole. Example of domestic tax subject in the tax treaty, Mr. Smith from U.S. citizens works for an oil company conducting exploiting activities in Indonesia. He is Indonesia 300 days a year. According to the Indonesia law, Mr. Smith is domestic tax subject or resident of Indonesia because he is in Indonesia for more than 183 days. Meanwhile, because the United States adheres to the principle of citizenship in determining a person's status of residence, Mr. Smith remains considered a resident of the United States.
Okay, next I'm going to talk about the beauty. So the taxation on business profit and permanent establishment or beauty. So in the absence of P3B, in accordance with the Article 26, Paragraph 1 on the PPH law, rewards in connection with services, jobs, or activities paid or out by government agencies, domestic tax subjects, even organizer, beauty, or representatives of other foreign companies to foreign taxpayers other than beauty in Indonesia, tax deducted by 20% of the gross amount by the party obligated to pay. With the 3B, in accordance with Article 7 of the Indonesian P3B model, the operating profit of a company from a treaty partner or the country that becomes Indonesia's partner in P3B will only be taxed in the treaty partner country or country of domicile unless the company conducts its business in Indonesia through a BUT located in Indonesia. So definition of beauty according to P3B, in accordance with Article 5 Paragraph 1 Model P3B Indonesia, for the benefit of P3B, the term of permanent establishment means a permanent establishment that all of part of a company's business is run. Just like the previous beauty type division, beauty can be divided into four kinds: beauty of asset types, types of activity, agent type, and types of insurance companies. So the example of beauty on tax treaty, Perry Inc., a US-based company, was rewarded with a management fee from PT Swift. The tax consequences will depend on the absence of Beauty Perry Inc. in Indonesia. If Perry Inc. Corporation have Beauty located in Indonesia, on the income can be taxed in Indonesia. Otherwise, Indonesia doesn't have the right to tax Perry Inc.'s incorporation's earnings, business profit, even though the operating profit comes from sources in Indonesia. Next. So, tax treaty imposed to dividend. The international tax aspect of dividends is stipulated in Article 10 of the OECD model, which has 5 paragraphs. Here is the formulation of each first. So, Article 10, Paragraph 1, dividends paid by a company which is resident of a contracting state to a resident of the other contracting state may be taxed in the other state. Paragraph 2, however, dividend paid by company which is a resident of a contracting state may also be taxed in the state according to the laws of the state. But if the beneficial owner of the dividends is a resident of the other contracting state, the tax so charged shall not exceed A, 5% of the gross amount of the dividends if the beneficial owner is a company and bracket other than a partnership, which holds directly at least 25% of the capital of the company paying the dividends. Point B, 15% of the gross amount of the dividends in all other cases. The competent authorities of the contracting state shall, by mutual agreement, settle the mode of application of this limitation. This paragraph shall not affect the taxation of the company in respect of the profits out of which the dividends are paid. Article 10, Paragraph 3, the term dividends as used in this article means income from shares or jouissance shares or jouissance right, mining shares, founder shares, or other rights, not being debt claim, participating in profits, as well as income from other corporate rights, which is subjected to the same taxation treatment as income from shares by the laws of the state of which the company making the distribution is a resident. Article 10, Paragraph 4, the provision of Paragraph 1 and 2 shall not apply if the beneficial owner of the dividends, being a resident of a contracting state, carries on business in the other contracting state of which the company paying the dividends is a resident through a permanent establishment situated therein, and the holding in respect of which dividends are paid is effectively connected in such permanent establishment. In such case, the provisions of Article 7 shall apply. And Article 10, Paragraph 5, where a company which is a resident of a contracting state derives profits or income from the other contracting state, that the other state may not impose any tax on the dividends paid by the company, except insofar as such dividends are paid to a resident of that other state, or insofar as the holding in respect of which the dividends are paid is effectively connected with the permanent establishment situated in that other state, nor subject the company's undistributed profits to a tax on the company's undistributed profits, even if the dividends paid or the undistributed profits consist wholly or partly of profits or income arising in such other state. Next. The allocation of taxation rights. From the formulation of Article 10, Paragraph 2 above, it can be seen that restriction on the right of taxation of the source state on dividends paid by the subject of domestic taxes only apply if the recipient of the dividend. Point One is the subject of domestic tax from another country or country of domicile, and point two is the actual beneficiary of the dividend or beneficial owner. As long as the two conditions above are met, restriction of on the right of taxation of the source country to dividend income apply the following conditions. Point one, the source state reserves the right to impose a tax on dividends at the maximum rate of 5% of the amount of dividends paid if the actual beneficiary of the dividend has ownership of the company paying the dividend at least 25%. The dividend received is called the participation dividend. Or, point two, the source state reserves the right to impose a tax on dividends at a maximum rate of 15% of the amount of dividends paid for all dividend payments except participation dividends. The dividend received is called a portfolio dividend. Next, the allocation of taxation rights to dividend income. So the allocation of taxation rights to dividend income, as you can see in the source country, entitled to impose tax on dividend income, but limited taxation right based on a certain percentage of the gross amount of dividend payments, usually 5% or 10%. Meanwhile, on the country of domicile, entitled to charge tax on dividends, but must provide multiple tax relief through the credit method mechanism as described in Article 23b of the OECD model. And then it is because to avoiding the occurrence of judicial double taxation through tax sharing. Next is going to present by Muthia Putri Hefra. Pada Muthia, the time is yours.
Thanks, Raihan. The next is dividend received by permanent established or BUT. From the formulation of Article 10, Paragraph 4 above, it is known that dividend will be treated as a business profit if shareholders in the domicile country have an effectively connected a relationship with but owned by the shareholder in the source country. Dividend as BUT operating income or income from free work or subject to income tax after taking into account deductible expense to calculate a net income basis. Based on the explanation above, the scope of application of Article 10, Paragraph 4 OECD model is as follows. The first one is a company that is subject of domestic tax from the country of the domiciles has a BUT or branch in the source country. The second one is BUT or a branch in the source country invests shares in the source's country and receives dividend on its stock investment. And a company in the country of domiciles have an effective relationship with BUT or branch in the sources country. Next is the tax treaty on interest. Provision on double tax avoidance of interest income have been formulated in Article 11 of the OECD model. So there are Article 11, Paragraph 1, 2, 3, 4, 5, and 6. Next is allocation of taxation rights on interest. So the source state has the right to tax. Restriction on taxation rights for the country of income sources of interest or with restriction on tax rates, usually 10% of the gross amount of interest payment. The second one is the country of domicile has the right to the country of resident has residual taxation rights over interest income. And the last one is the multiple tax avoidance. Use of tax credit method. So in the Article 23A, Paragraph 2 or Article 23B of OECD model by domicile country. So note, in the relation to interest income, in Article 23A and 23B of the OECD model provide a method of tax credits to eliminate the occurrence of multiple taxes. So, next is tax treaty on royalty and rent. In the Article 12 of the OECD model governing aspect of international taxes on royalties has 4 paragraphs. Here is the formula. The first one is the paragraph 1. Royalty arising in a contracting state and beneficially owned by a resident of the other contracting state shall be taxable only in the other state. The second one is the paragraph 2. The term of royalty as used in this article means payment of any kind received as a consideration of the use of or the rights to use any copyright of literally artistic or scientific work including cinematography film, any patent, trademark, design, or model plan, secret formula or process, or maybe for information considering industrial, commercial, or scientific experience. The third one is in the paragraph 3. The provision of paragraph 1 shall not apply if the beneficial owner of the royalty being a resident of the contracting state carries on business in the other contracting state in which the royalties arise through a permanent establishment situated therein, and the right or property in respect of which is the royalty are paid is effectively connected with the such permanent establishment. In such case, the provision of Article 7 shall apply. So, and the last one is in the paragraph 4. Next is the allocation of taxation right. The first one is the OECD model grant domiciliary country the right to impose tax on royalty and does not allow sources country to impose tax deduction on royalty as stated in Article 12, paragraph 1 of the OECD model below. So, royalties arising in a contracting state and beneficially owned by a resident of the other contracting state or country resident shall be taxable only in that other state or country residence. Next, we talk about the allocation of taxation rights. The OECD model grant domiciliary country the rights to impose taxes on royalties and doesn't allow sources countries to impose tax deduction on royalty as stated in the Article 12, paragraph 1 of the OECD model below. So it contains of the royalty arising in a contracting state and beneficially owned by a resident of the other contracting state. Next is principle of tax imposition in Indonesia. The Indonesian government basically addresses to the principle of taxing all income, including income from abroad. From domestic taxpayer, tax imposition is based on the domicile principle. Meanwhile, foreign citizens who lived and earned income in Indonesia check the time limit to determine whether an individual or entity is a domestic taxpayer or living in Indonesia for more than 183 days in 12 months, or is a foreign taxpayer and living in Indonesia for more than 183 days in 12 months. In Indonesia, a maximum of uh, in Indonesia, uh, a maximum of is 183 days, while for foreign taxpayer, it is only imposed on income earned in Indonesia. Furthermore, as is common with taxation practice in various countries, tax treaties between countries are regulated to avoid double taxation. As for the distribution of tax rights of a country based on the distributive rule stipulated in the tax treaty, basically are as follows. The first one is the right of taxation is fully granted to the country, generally given to the country where the tax subject is registered as a domestic tax subject. The second one is taxation rights are divided between the country of domicile and the country of sources of income. In the distribution of tax right of a country, the tax treaty developed by this OECD model tend to provide the domicile country with as many tax collection right as possible. In other words, the provision contained in the distributive rule are intended to limit the tax right of the sources country. Well, in imposing tax on taxpayers, tax collection institution must pay attention to various factors related to the sources of the income or benefit tax tax object and recipients of income or benefit or tax subject. Here, hereinafter known as the principle of tax imposition. In the description below, various principal tax imposition are presented. The first one is domicile principle or domicile and resident principle. Based on this principle, the state will impose a tax on income received or obtained by an individual or entity if for tax purposes. The individual is a resident or domiciled that country or an entity that is domiciled in that country. Uh, in this connection, if that if doesn't matter where the income to tax comes from. Well, the second one is uh, principle of nationality citizenship. And this principle, the basis of the imposition of taxes is the citizenship status of the person or entity that earns income. Based on this principle, it doesn't matter where the income to be taxes from. As in the domicile principle, the taxation system based on the national principle is carried out by combining the national principle with the concept of taxation on income earned abroad. And the last principle is sources principle. Countries that adhere to the source principle will impose a tax on income received or obtained by an individual or entity only if the income uh, to be taxed is obtained or received by the individual or entity concerned from a country. In this principle, it doesn't matter who and what is the status of the person or entity who received the income because the person who because the basis for the imposition of taxes is the tax object that arise or originates from the country. For example, foreign works in Indonesia, so the income earned in Indonesia will be taxed by Indonesia government.
Okay, I think that's all for our presentation. Thank you very much for your attention. Assalamualaikum warahmatullahi wabarakatuh.